I want to provide a few examples of expectation and reliance damages and how they are calculated just to supplement the textbook a little bit. So let's take a look at a couple examples. The first example, John agrees to purchase a tract of land from Jane for 100 grand. Jane breaches the contract, refuses to transfer the land to him. What are John's expectation damages? And let's look at the first one. At the time of the breach, the land is worth $125,000. In order to determine what John's expectation damages are, we have to figure out what did he expect to benefit from the contract. Well, he expected to have a $125,000 piece of land, but he also expected that he was going to be paying $100,000 in costs. That's how much he expected to pay for the property. So he expected to be up $25,000. Those are his expectation damages. Let's look at example number 2. If at the time of the breach the land is worth 100 grand, so the land is going to be worth exactly what he paid. John's expected benefit, 100 grand, less the costs that he was going to have to incur to obtain that expected benefit, 100 grand, equals 0. There are no expectation damages. And the third one, at the time of the breach, the land is worth $75,000. Because the land has reduced in value, his expected benefit is actually in the negative, $75,000 minus the $1,000 in cost. He expected to be in the hole at the end of the contract, and therefore there are no expectation damages available to him in that circumstance. It gets a little bit more complicated when we start looking at deposits. So same facts. John is purchasing land from Jane for 100 grand, but John has already paid a $50,000 deposit before Jane breached the contract. What are John's expectation damages? So let's look at a circumstance where at the time of the breach, the land is worth $125,000. What we really need to figure out is where John is and where he expected to be, and find the difference, and that difference is going to be his expectation damages. So where is John? John is out he's in the negative. He's negative $50,000. Where does he expect to be? He expected to be positive $25,000. He expected to have the benefit of $25,000 because the land went up $25,000. What's the difference between that? The difference is $75,000. Those are going to be his expectation damages. And again, what that is doing is that is taking John from where he was, which is negative $50,000, to where he expected to be, which was positive $25,000. The second example, at the time of the breach, the land is worth 100 grand. Well, John expected to gain nothing from the contract. That's where he expected to be. He expected to be at 0. Where he is at negative 50,000. So his expectation damages in this case are going to be $50,000. Really, Jane has to pay the deposit back. In the third example, again, because the land is worth less and it was a bad bargain, John can't really expect to have any benefit from the contract. So since he cannot have an expected benefit, his expected benefit is a loss, he can't recover expectation damages. His expectation damages are 0. He will, however, be able to recover the $50,000 deposit through other mechanisms, other damage mechanisms, such as something like unjust enrichment and restitution. Now let's look at reliance damages. John's paid $50,000 deposit to purchase the land from Jane. Jane breached the contract, failed to transfer the land. What are John's reliance damages? The first example, if the land is worth $125,000, because the contract is profitable, John expected to turn a profit, he is going to be entitled to claim the whole $50,000 in reliance damages. In the second circumstance, however, his ability to recover reliance damages is going to be limited. If the land is now worth $75,000, John expected to lose $25,000 in any event. So had Jane performed, John expected to lose 25 grand. Accordingly, John is only going to be entitled to reliance damages to the extent that the contract is not unprofitable. What does that mean? Is that since he stood to lose $25,000 if Jane had fulfilled her obligations, he's only going to be able to claim his reliance damages less the loss that he was going to suffer in any event. In this case, $50,000 less the $25,000 that he expected to lose in any event. Now, I wanted to look just to compare the two, because of course litigants are able to claim both expectation and reliance, and if they are successful in the lawsuit, then they do the number crunching and determine which one they want. There are circumstances in which expectation damages are better than reliance and vice versa. The example in your textbook is where you have hired Ursula to perform a contract. You've paid $5,000 and you expect a net $7,000 profit if she performed. She breached and you canceled the contract. Figuring out which is preferable, your expectation damages or your reliance damages. Reliance damages are the easier calculation. If you look at the reliance damages, you paid $5,000, you didn't get a concert, your reliance damages are $5,000. Let's look at your expectation damages. Well, you expected to have a profit of $7,000. You expected to have $7,000 in your pocket. Where you are, however, is that you are negative $5,000. So in order to get you to the place where you expected to be, $7,000, we need to pay you not only the $5,000 that you're out, but the additional $7,000 to account for the profits where you expected the expected profits that you were expecting as a result of the performance of the concert. Accordingly, your expectation damages are $12,000. In this case, prudent business person, realistic business person is going to choose expectation damages.